What's going on, guys, and welcome back to another video. So yesterday was quite a strange day in the stock market, right? So we saw Microsoft, Apple and Google publish their results, and all of them had absolutely fantastic results. They were really good. And yet we saw Microsoft's share price fall, and then we saw Apple's share price fall as well. And Google, who to be fair had the best results out of all of them, they saw a relatively measly 3% increase in their share price. And when you actually look at how good their results were, that's quite surprising as well. But as I'm a shareholder of Microsoft and I'm not a shareholder of the other two companies, I thought that today I'd make a video on Microsoft and what my plan is going to be for the company going forward. But just before we get into that, I wanted to give you an idea of what I'm talking about when I'm speaking of really good results that these companies are publishing, and yet we see a contrasting result in the share price, right? So Apple's share price fell by 1.2%. If we just quickly look at the highlights of their earnings call. So they had earnings per share of $1.30 versus an estimated $1. So they've literally smashed their estimates by 30%. The share price still fell. So what else have they got? Revenue was $81 billion compared with what analysts were expecting of $73 billion. So that's a 10% beat on expectations in itself. And then that is also up 36% year over year. So absolutely phenomenal growth for a massive player like Apple. And then gross margins were 43% compared with what analysts were expecting of 42%. So Apple have published some really good results, and yet the share price has fallen. So it's quite strange, but if you actually think about it, it's not that surprising. And it's all driven by the fact that so many investors have come to expect that these big companies, so your Facebooks, your Apples, Microsofts, Google, are just going to absolutely outperform the estimates every single time. And we've seen massive share price appreciation as a result of that. So Apple is up almost 53% on the year. Now this is for a company that has a market cap of $2.4 trillion. So it's not like it's a small growth company where you might expect there to be large share price appreciation. We're talking about the big players, and it's the same for all of these larger companies within the S&P 500. So a lot of these larger companies are trading at all-time highs, and they're trading at multiples which are larger than they've ever been before. So I'm sort of skeptical about the growth in some of these larger companies compared to some of the smaller cap or mid-cap companies that are out there. So that might give you a little bit of a hint as to what I'm going to do with Microsoft going forward. But let's get into it. So on May 12th, I published my deep dive analysis video on Microsoft. And there I said that I thought that the company was worth around $263. And I think at that time it was trading at $239. So a little bit of upside there. And what we're going to do today is go through the earnings report and then update my discounted cash flow and earnings multiple model and decide whether we should continue to accumulate more shares, sell the shares, or hold. So as I said earlier, right, Microsoft's earnings were actually really good. So revenue was $46 billion, and that's a 21% increase year over year. Now, when we think about how big Microsoft is, to be growing at 21% year over year is really impressive. So that's always good to see. Operating income for the quarter was $19.1 billion, and that was an increase of 42% year over year. And then net income was $16.5 billion and increased 47% year over year. So the best thing about this, right, is that their revenues are growing at a decent rate, but their earnings are actually growing at a greater rate, which means that they're seeing margin expansion, which means that the company is becoming more and more profitable, which is always good for us shareholders, right? So that is very good. Straight away, the highlights are looking good. And then I won't go through each of the individual business segments here, but one of the things that I am interested in is their revenue in intelligent cloud. And that was $17.4 billion, which was an increase of 30%, which is very good. So their cloud business is growing at a quicker rate than the other segments in their business, at least on average. So that's very good. And then most importantly for me, because I'm very interested in this space, their Azure revenue growth was 51% or 45% in constant currency. Now, following the earnings report, right, I read a couple of articles, and one of them in particular from Yahoo Finance said that although Microsoft topped their earnings estimates, which was very good, their Azure growth trend spooks investors. And effectively, the long or short of the article is that Azure's sales increase of 51% in the period disappointed some investors because it was partially fueled by currency fluctuations. The number drops to 45% without that boost, representing a slowdown from the prior period. So I think that this is probably somewhat exaggerated, right? Because Azure revenue had gained 50% from a year earlier for the prior 2 quarters, and then this quarter it's 45%. So I think that drop in 5% is not that significant considering the fact that it has been growing at 50% for each quarter. So we're all very aware of the fact that as a business grows and as the revenues grow larger, it becomes harder to grow at the same rate of speed. So a drop from 50% down to 45% is not something that, in my opinion, should sort of push the share price down. And then finally, from a quarterly perspective, we can see here that Microsoft returned $10.4 billion to shareholders in the form of share repurchases and dividends in the fourth quarter of fiscal year 2021, an increase of 16% compared to the fourth quarter of 2020. Now, I don't think that share buybacks are actually spoken about enough by investors, right? Or at least people on YouTube. So I prefer share buybacks to dividends. I just think they're a better way of returning capital to shareholders. And if a company is buying back shares, what they're doing is they're increasing your own individual weighting within the company. So I now own a greater proportion within that company. So share buybacks are really good and they're not spoken about enough. Over the last 5 years, Microsoft's number of shares outstanding has decreased year on year, so that's very good. And that will continue out into the future as well. So I'm happy from that perspective. And then finally, if we just look at their results from an annual perspective, right, because this was their full year results as well. So revenue was up 18%, which is very good for a company of this size anyway. But the best thing here, right, is that their operating income was up 32% and their net income was up 38%. So what I was saying to you earlier regarding sort of margin expansion, and when revenue grows at one rate and then your net income grows at a greater rate than that, that's something that we should all be looking out for. And the fact that it's happening with Microsoft makes me very happy as a shareholder. And it just gives me confidence that the business is still doing very, very well. So unfortunately, I wasn't actually able to listen to the earnings call at the time, but I did read through the transcript, right? And to be fair, there's actually not all that much in there of any interest, which isn't already in the earnings slides, right? But one thing that I did find interesting was a question from a Morgan Stanley analyst. And he effectively is asking the question of how much of the growth that Microsoft has witnessed over the past year has just sort of been brought forward from sort of future years, and how much of it is actually sustainable going forward. And Satya Nadella, the CEO, actually came out and responded quite well to that. He effectively said that tech spend as a proportion of GDP is projected to double, and I think that that double will happen in a more accelerated pace, and we feel well positioned because of the innovation across the stack. He said, if you think about it, what's going to happen in every business, whether you're a retailer or a manufacturer, in the service sector, public sector or private sector, digital adoption is the way you're going to be both resilient as well as transform the core business process. And the strength we have is the entirety of the Microsoft Cloud stack. He said, so it's not just about the infrastructure or any application, it's the entirety of what we do. And so I think it's durable, which is actually really positive, right? Because a lot of analysts are actually expecting a slowdown in the growth of sort of Microsoft's revenues and earnings. So if they are able to sort of maintain the level of growth that they've been achieving, at least over the last year, for at least a few more years, then definitely that will bump up the value of the stock. So what we're going to do here, right, is flick back to my valuation model and make a few adjustments to the sort of inputs to that model based on the sort of latest information that we have. And then we'll come up with an updated sort of intrinsic value for the company, and then determine whether we are going to buy, sell or hold. So if we start with 1 to 5 year revenue growth, right, so I had initially put in revenue growth of 14% for the next 5 years. And you can see that for the last year, they had achieved 18% revenue growth. And prior to that, it was 14, 14, 23, and 5. If we just flick across to Zacks, we can see that according to them, analysts are expecting revenue growth or earnings growth over the next 5 years of 13%. And according to Yahoo Finance, analysts are expecting 17%. So I think somewhere between 13 and 17 is probably fair. If we bump this up to 15%, considering what Satya Nadella had said in that he thinks that the growth that the company is witnessing is actually stable and sustainable. So I think 15% is probably fair. For 6 to 10 year revenue growth, I'm going to leave that at 10%, which is probably quite conservative, but I'd rather be on the safer side of things. Now for gross margins, we had actually put in 67%, but we can see that for the most recent year, their gross margins were actually 69%. So if we can assume that they can maintain those gross margins, and we input 69% into our model going forward. For operating expenses as a percentage of revenue, so we can see that the average of the last 4 years has been 31%. I actually think if we go somewhere in the middle between that, right, so we saw that the latest year was actually 27%, and we actually saw that quarter over quarter operating expenses, or sort of operating margin, was actually increasing. So I think that 29% is probably a fairer reflection there. So we'll input 29% into our model. For free cash flow as a percentage of revenue, we had 31%. If we actually look at the average over the last 5 years, the average was 31.5%, but we can see a slight increase as time goes on. So I think 31%, 32% is probably fair. So we'll leave that as it is for now. And then we're going with a terminal growth rate of 2% and a weighted average cost of capital, which is a calculation of 7.3%. And then if we flick across to the valuation that we get as a result of that, so according to the discounted cash flow model, we have a valuation of $314. And according to the earnings multiple model, we have a fair value of $255. which gives us an average estimated intrinsic value of $284. And I think that today it is trading at, let's have a look, where is it? $285 in the pre-market, right? So we are slightly down. That should really be red. So it's at about fair value according to this model. The one thing that you should bear in mind with this, right, is that this is using an expected PE ratio in 10 years time of 22.5. And the reason I've used 22.5 is because that's the average of the sort of last 10 years PE ratios. But the current PE ratio is actually something closer to 38, I think. So if we have a look, the trading PE is 35. So the multiples that they are trading at right now is actually really high. And I think actually there's quite a nice chart to show this. So if I go across here, with the exception of these two peaks, which I can't remember what the reasons for those were, but effectively they are anomalies and you shouldn't really take them into account. We can see here that the PE ratio is always generally quite between around 20 and 25. And actually, when we go back to 2011, the PE ratio was 7.5, which is absolutely ridiculous. And I wish that I was buying shares back then. But yeah, we can see that around 2025 is probably a general average. And right now it's trading at historical highs. So it is an expensive company right now. And that's why we see a sort of higher valuation. If we were to think that in 10 years time, and I don't believe this for a second, but if we were to think that in 10 years time that Microsoft would still be trading at around a 35 PE ratio, then our valuation all of a sudden says that this is sort of worth $356. But anyway, I certainly don't think that the PE ratio in 10 years time will be 35. So I think that 22.5 is probably a more fair number to use. And it definitely makes me feel better to use 22 rather than 35. So I think that the company is probably about right in terms of where it's valued currently. So what does that mean that I'm going to be doing? I'm not going to be buying any more shares. My current cost basis is actually $213. I started buying some shares around $190 and I continued to average up whilst it was at around $230. And now I'm not buying any at the moment because I think it's fairly valued. This is a stock that I want in my portfolio, but I'm not prepared to pay this price at this time. So it would be nice if we saw a pullback and then I could add to my position, but for now I'm not going to be doing that. So I don't think it's something that I want to sell because I think it's a great stock to have in your portfolio, but it's not something that I'm going to be adding to at the minute. So definitely a hold for me at this time. Anyway, guys, I hope you found the video useful. Until next time, thank you.